All right, so we dropped today 2.93% on the S&P 500, and that was a good thing. I'm going to talk about why. Why is a barely less than 3% drop actually a good thing? Like a month ago, a 3% drop, barely less, would have been a horrible thing. And now it's actually a really, really good thing. So I'm going to show you some of the signs that this extreme selling pressure is abating, and that there's going to be a big up move here, and a historic up move, like top 10, potentially top 15 size percentage move to the upside coming up tomorrow or next week. I'm going to show you why, what we're looking for, how far up that type of move can be. Not that I think we're getting a V bottom and that we're going to trend to the upside, but we'll talk about what to do if and when that type of mood comes, and how to trade it going forward from there. We're also going to talk about a stock that hasn't been participating to the same degree in the selling, but is kind of at a pretty strong support level itself, that if it does break, it's got an opportunity to really catch down to where everything else is. And we'll talk about how to trade that in context of what else we have going on. So let's go ahead and get started. Today is Monday, March the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we look at the charts really quickly, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below us here if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video on YouTube as well. That tells us two things. Number one, you liked our video today. Number two, you want us to do another one tomorrow. It's a quick way to give us feedback. We look at it every time to see what you're thinking. You can click on that right now while you're watching. Also, write down there, comment on what you got out of the video today. What stood out to you? What questions or comments do you have about what we talked about? You can post those down there and reply to anybody else's comments as well. Join our website at MarketScholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, well, let's start off taking a look at the market forecast indicator on the S&P 500. We've got our third oversold cluster on the S&P with a little bit of a drip. It's kind of flirting all day with this cluster here. You can see the momentum line in oversold territory, the near-term line dipping its toe, even though we came off of the low a little bit. The intermediate posture is still strongly bearish. It's down in that strong bearish zone. I mean, just to kind of give you an idea of when, how long that near-term line stays in this territory. Look how basically it's been, brief little light green shading here, but in terms of like how long do we have dark pink shading before we get light green. So it's different when you're strongly bullish. You get dark green shading in very brief periods of light pink. You see them in between. That means that we dip below 80. We're weakly bearish but strongly bullish most of the time. You see that's the case more often than not. When you're dark pink, you notice that you're not very dark pink for you're not dark pink for very long before you get light green. And you might get multiples, like they came in waves over here. And you notice during this little decline, it was brief. We popped up, we got dark green shading, then we came back down again, dark pink. It was brief. We flirted with dark pink, light green, dark pink, light green, before we had another brief little period, another brief period there. Obviously, with red lines is what makes it bearish. Here, let me do this here really quick, so you can see this a little bit better. All right, so here's a brief little pullback in 16, dark pink brief, and then you got we're still bearish, but you've got dark green, light pink, and then a couple brief periods of dark pink, and most of this doesn't include the intermediate line below 20. For the most part, it's just below 50. You can see it just doesn't stay, like none of this was below 20 at all on the intermediate line. Over here you can see very brief period there below 20. This is our biggest period below 20. Just down and back up again, and you can see the rally it had coming out of that. Here's another period in 2016 of dark pink, light green, dark pink, and then our rally, same here, dark pink, didn't last very long, didn't stay below 20 for very long. We got the light green again, and then the fall back down again, didn't last very long, didn't stay below 20 for very long. there in 2015. Here's 2011. That was 2014. That's the Ebola virus, actually, and we came down with big, long, lower shadows there. You come out to 2011, so you can see quite a big period of dark pink because we fell so far, but then light green, dark pink, very briefly below the intermediate. In fact, that one we were below 20 for the kind of longest period of time. We didn't really fall very much in June. But then you can see how we just don't stay, the intermediate line doesn't stay below 20 for very long. And we don't stay dark pink for very long before we get light green, which means we get these big sharp bounce up. And this one got a dark green, but that got a big bounce up and got light green. That got a big bounce up and got light green. That's a pretty decent sized bounce up. And then of course a big bounce up there to get the light green shading. So here we are now, of course, deeper than we've been in a very, very long time. And here, let me do this. Let me go back to, so you can see 1987 and see what that dark pink shading looked like back then. So I'm going to forward this over here all the way to the left. So give it a second to pull it up. There we go. And zoom in on it. So there's our 1987. Again, very big declines. Dark pink shading, but look how many light greens we got. We got a big move up to get us light green. We got another big move up to get us light green. And look at the back and forth, back and forth, back and forth. Still bearish this whole time, but we're not dropping off a cliff. And again, you know, if I were to go all the way back to 1929, so you can see what that looked like, 1931, to give us some perspective here. Alright, so here we are. There's your big dark pink shading. Lots of oversold clusters, which is kind of what we're getting right now. Very far below the moving average, and then a big move up to get you light green. Brief dark pink, big move back up to get light green. And then you can see dark green shading. And as you can see during the dark green shading, very, very briefly light pink. And then we get the dark pink, followed by spurts of, you know, very short periods of time. Then we have this big decline, followed by a big move up that got you light green. And kind of flirted around there. Big. That was probably the biggest, worst drop in 1930, October of 1930. So well after a year after that rally, and then you started to break up the dark pink shading over here after all these clusters, and then you can see the move. We had a really strong move actually right there, coming off of that extreme low point. So just to kind of give you an idea that, like, I mean, this is a pretty decent period. I mean, even that period was broken up with light green shading on that big decent move to the upside. You know, we're going to get a decent move to the upside, the biggest moves to the upside on the market, right? When they talk about you're going to miss the 10 biggest days in the market, well, those 10 biggest days typically occur the furthest away you are from these 30-day, you know, these moving averages. Well, it's 30-day, 200-day, whatever the case is. To kind of give you an idea, if I were to go outside of the Great Depression period, if I were to go back to 2008, this would be, let's see here, and I'm just going off of good old Wikipedia here, but if this would be the 5th biggest up day that we've had, percentage-wise, mind you. Percentage-wise was 1013. So that's this day right there. Again, we were really far away from the moving average there, and that was our big day. 1028 was the 6th biggest day percentage-wise ever, and look how far away we were from the moving average coming off of that cluster there. Then you have to go now to 2020. Barely this day here, the autographed day, coming off of a cluster, that was the 9th biggest percentage move higher that we've ever seen in the S&P 500. 1987 is on the list. Let's see, let's go back to 1987. Another period where we were extremely far away from the 30-day moving average. Way over here, there we go. So it would be October the 21st. This day was the 10th biggest rally that we've had in the S&P 500. Again, just coming from way below the moving average. And then we have a bunch of periods in the 1930s. So, I mean, again, if I were just to go point-wise, you can see all of these were some of the biggest point movers 313 was the biggest point day. 317 was the second biggest ever. 3.2 was the third biggest ever. 3.10 was the next biggest. 3.4 is number 5 all time. So I mean, these are all the biggest point moves that we've had. They get bigger the further away we are, especially on a percentage basis. The further away you get, and with these oversold clusters, it might happen tomorrow, it might be Wednesday, it might be Thursday, but you're going to get, one of the all-time biggest point or percentage moves because of how far away we are from the moving average. Whether it's the moving average, and again, these oversold clusters, and how pink the shading has been, and how long it's been. We don't typically get very long periods of dark pink shading. We usually get some light green pretty quickly to break it up, and those light green shadings come from big moves that happen. One really nice benefit is that the down moves we've been getting have been progressively lower, and you can see the volatility index, the VIX, has been dropping. This is an implied volatility for SPX, but that's equivalent to the VIX. Right, has been dropping here, whereas historical volatility is still pretty high. Today's range, much smaller than average. So lots of really good signs with the moves getting smaller that things are slowing down, the descent slowing down. And as I mentioned before, if I go back to that 2008 period, let's go to the 2008 period here, up to say 2009. All right, so this day was what was this? This was the 5th biggest update that we've had, and you can see, the VIX, the historical volatility had climbed up above the VIX. Here was the 6th biggest day right there, and again another period where the VIX had dropped while historical volatility was as high as it is right now. The historical volatility is right up in this area. So there's going to be a big up move here now that our volatility index is below historical volatility. It'll just be like a one-day move, that's all. It might be followed up by much smaller gains, but we haven't really followed up this big decline with a big move up yet. And look for that to be coming like a tornado, right? We won't be able to expect it. It might be tomorrow, it might be Wednesday, it might be late in the week, it might be next week. But that type of move is what we've seen in the past when we are this far away. And to give you an idea of how far away we are from the moving average, or how fast this decline has been, if I go to the rate of change here on the S&P 500 over the last quarter, so last 3 months, 63 days. This is a 63-day rate of change, so it's a quarter basis. We are down 30% in the last quarter. Let me give you an idea of how significant that is, because we were just barely up 12% on a quarterly basis. And that's a pretty decent return for a year, much less a quarter. So we went that far down that fast. Look at all the other periods where we dipped really quickly, and look what happens to the rate of change over 3 months. It goes up pretty quickly. Same thing, even from these lower levels, it goes up to about the same level. Let's come over here to, here's 2011, right? August 2011, we dipped down. We dip right back up. Boom, quick moves to the upside. Here's the bigger move in 2008. We did get to a lower low, right, after that November 20th dip, where we are down more than 40% year-to-date. Excuse me, not year-to-date, but on a quarterly basis. And then we rallied really sharply. Here is 2002. We were close to a 30%, down 27%. And you can see the rate of change moving up to really sharp moves to the upside. And you see the same thing in 1987 and in 1929 as well. Here's 1987. This is as far down as we got. After we actually retested these lows, we got this far down on a quarterly basis. And look at the move back up, just like that. Over a 3-month period, we're back up 20%. So, again, we're not going to come out of this quickly. It took more than a year to get back up to these highs that we had fallen back from. All the way to 1989 is by the time we got there, and we kind of flirted around there first before breaking through, and then retested those lows. And then we had this dip in 90, and you can see that big move up in the rate of change. So that, not only are we going to get a big move up in a short amount of time, that will probably get us up to this probably get us up to at least the 17-day moving average, if not the 30, and get that light green shading, yellow line, bearish pattern, retest the lows as probably earnings reports start coming out and showing how dire things are, and economic figures coming out, and expectations for growth dropping, right? We'll retest these lows. The market's already pricing all that in. That's why we got to the lows. Then they'll start coming out with these, and we'll retest those lows, and then it'll be that buy the rumor, sell the news phenomenon where we'll start to come off of that, as we saw in 1987. So big move up in the short term that will get us to at least the 17, if not the 30-day moving average, with that MACD getting up to the histogram getting up to a positive, not the MACD getting a positive itself because it's really, really low, but the histogram getting positive as it rolls up. Then it will roll over. And I've shown you this chart too on the PPO basis, like how far away we are right now below, say, the 200-day moving average. And then we'll look at the 30-day moving average. But this is how far away right now we are below the 200-day moving average. Let me change it to this. So there we are down there, about 25%. So for some perspective on how far below we got back, right here, let's just go all the way back. For some perspective on how far back we got in some of these other time frames, you can see, we didn't even get 10% below during 15-16. We get just barely over 10% below in 2011, and then here's the Great Recession. We were way below the 200-day moving average and flirting with the 30-day multiple times there. There's the end of the recession in 2002, after a couple retests, of course. 1987. This is as far as down we got below. We were just over 20% below the 200-day moving average before reaching the low point. And of course, way back here in 1929, we dipped a little bit more than 30. So that's a key number, a little bit more than 30. And we jumped hard back to the 200-day moving average when we got that far below. Well, 30%, that's almost where we're at right now at 25%. So we are well below the moving average. And then if I look at here, this number, and take a look at the 30-day moving average, how far below that we are. So we are nearly 20% below. And so some perspective on that, that's the furthest away from the moving average we got in the Great Recession. We got this far below the moving average, just nearly 20%. At the end of this recession, we were down about 14% below. In 1987, we got this far below, right here, we got this far below the moving average, the 30-day moving average. We were down below here previously, and we double dipped to that point. So, and then of course, way back over here, in 1929, this is how far below, and then we double dipped to the same level, and that's when we got this far below the 200-day moving average. So, again, what I'm saying is, and if again you go to another linear regression, you see why we're even though the volume is still very, very high, why we're not dropping and why we're below average now on a lot of these trading ranges is because we are so far below. I mean, we have dipped below the midpoint here on the March. Look at all the volume we've had this month compared to prior months. It goes all the way back to August of 11. We've had this much volume. You go back to the 10-year chart, you can see we are 2 standard deviations below the 10-year standard deviation. Look at the 5-year standard deviation. We are 15-year. We are 1 standard deviation below the 15-year. The further back you go, you kind of get an idea of, see this is 2020, so it'd be 1990. To go back 30 years back, you can see we're dipping below the midpoint. I mean, that's a significant move after having been so bullish for so long. That's a significant move to the downside. To kind of give you an idea, if I were to go back to October of 2018 or 2008, the end of the month in October 2008, and then we'll go October 1st of 1978 for a 30-year move there. I mean, we were 2 standard deviations. So that's the big difference now. In 2008, again, we had an extended bear market run then that we're not getting necessarily. Well, here, let's do SPX. Sorry, I need to go back further. There's SPX there. So we were below the first standard deviation there. And now let's go back here. There we go. Oh, shoot. There we go. Sorry. Now this is the 30-year going back on the S&P SPX. SPY didn't go back 30 years from now. But you can see how again, that first standard deviation coming into that zone right there. We've talked about the significance of that zone on SPY as, if we were to keep going down, how much further down can we go? We talked about this volume node right about 2. Well, here, let's get rid of the expiring cone here. Right into that area, this 210 area. That's where we were in 2015-16. Well, we got down to 218 at the low point today. We might grind our way down into that low point. That's a significant low on the 5-year, as well as a pretty significant volume node on the 10-year as well. And then going all the way back as we possibly can on SPY, you can see where it stands out there. I mean, that's a big ledge for us to hold up. If we don't hold up there, then there's not very much of a ledge below there to keep us from falling down. Going to the 10-year chart, you can see the next ledge is down below 150. It's like all the way down to 135. So that's a really, really important ledge. There's going to be a lot of buying support because obviously I'm not the only one that sees that. Everybody's kind of looking at that level of 2015-16 as a lot of buying support there. So if we start to grind our way down with smaller trading ranges and smaller moves here, let's see, where's my, it would be, sorry, this one. You can see as long, once we start rolling over on the ranges, as you saw, smaller than average range, and then the volume starts to level off as well and starts to roll back down. Then you'll start, and for that matter, as we've already seen on the other chart, the VIX starts rolling over too and starts heading back down and staying into this kind of neutral in this bearish zone, but in the lower end, not so extreme to the upside. Then we'll have a good chance to bounce off of that strong support level and make our way back up again, at least to, in the short term, the 17, maybe the 30-day moving average. Eventually, after a few months, back to the 200-day moving average, and then that's going to be the big, what's going to happen. Are we going to break through it and continue to move like we did in January of January of 2019? And every other death cross environment that we've had for that matter here recently, or are we going to fail like we did in the early or May of 2008, like we did in May of 1929, and roll over from the 200 and start more of a multi-year decline, like we did in 2001 as well, early 2001. So that's what we'll see if we get to the 200-day moving average or not. But that will take a few months. Whereas in the short term, because of how extremely low we are, really good opportunity to make a big, fast move out of nowhere back up to that 17, if not 30-day moving average. And then at that point, again, we'll have light green shading again, right? Because that's what happens in the market forecast. You break up all this dark pink with light green shading there. And if we get the yellow line to go with it, that's going to be a really bearish pattern to sell off from that moving average to retest those lows. And you'll see us make some more bearish trades as a result of that to retest those lows with. Let's take a look at what this week's Hakunashi candle looks like. Zoom in here and on the weekly candle. Let's see, I don't have it on the Hakunashi. Let's do the Hakunashi. All right, so you can see we're still closing as of right now below last week's low on the Hakunashi. Closing above these lows is what's significant, right? That's when you've got an opportunity to kind of halt the flow a little bit when you close above these lows candles. Because remember, the Hakunashi close is an average of 4 prices, not the actual close for the week. It's an average of the actual open, high, low, and close of the week. Whereas the low of the shadow is the actual low of the week. So if the average price for this week's open, high, low, and close can stay above last week's low point, It doesn't necessarily mean that we're rolling back up to the upside, but it does slow down the selling a little bit, and we've seen that, for example, over here. And then when you get this type of pattern, this really small range, very small range relative to the candle, that's when you say, okay, that's when we're reversing and we're making a run back up to the 200-day moving average. You can see it over here too. You got these big candles, you got a little bit of a body there. You see how we're not closing below these lows, and then we jumped right up there. There's that smaller range, small body coming off of here, and we roll back up to the upside. Here's the 2011 here. Lots of small bodies before we really got going to the upside here. Big long lower shadow, but closing big. That means we had a big low point there, but we ended up closing above that low of that candle the prior week. Very I mean, again, takes the pressure off the selling when you get closes above those lows in the Hakunyasha. You can see the reversal candles here. You can see the reversal candles on these. They got us back to the 50, and then a few, we're riding the 50 down. Here's our reversal candle, very small body, not closing below that low, and then a reversal back to the 200 in that case. So you see how this works, right? You get, you know, these small reversals and you know, candles, and we move back up, and you know, we stop closing below the lows of these candles. Even though we might get lower lows, we're not closing below those lows. It just puts the pressure off a little bit. When we're closing below the lows, that's a lot of pressure. That's a lot of selling pressure. Boom, boom. You know, that's big selling move. But then it abates, right? Then it abates and we're done. So here we have had multiple weeks where we've closed below the lows. We've had one big selling pressure right there. We've had two big selling pressure right there. And now, as of right now, this would be three, which is a long period to do this. But if, you know, again, if we end up closing above that low point, then you know the selling is abating. We're slowing down. Look for a candle, a transition type candle with a really small body but a large range for the body. That's your reversal, right? That's the reversal that will at least get back up to the 50, which is, you know, pretty far up above where we're at right now. If not eventually back up to the 200-day moving average here. Let's take a look at the range, and again, to kind of give you an idea of on SPY, like for example, where that 50-day moving average is right now at 281.13. Well, if I look at the intraday moves for SPY, 281.13 is way up here. So I mean, again, the move back up to there would start to fill in these gaps that we've talked about filling in. And you know, today right now the futures are up like nearly 4%. And now granted, it's early and things can change, and we all know things can change overnight with the pajama traders. But if we gap open significantly tomorrow, because again, you're watching for the breakaway gap, right? The runaway gap, where we're starting a new bullish run here on the intermediate posture, right? That eventually might turn dark green shading for all we know. It starts with a runaway gap, and a runaway gap is a good gap to the upside that doesn't get filled, and maybe a little chunk at the open, but this is a little tiny chunk comparatively, and then we just rally throughout the day. So if that ends up happening, if we end up finishing or starting the day with a really strong opening gap, most likely it will get filled, because that's, you know, most of these gaps are common gaps, and common gaps get filled. But if it is going to be a runaway gap, it won't get filled right off the bat. You'll only see a little bit. So that's what we're going to keep our eyes open as we head into tomorrow morning. If we maintain a strong, like 3-4% rally, that would be a good gap. That, you know, if we can build on that with the regular trading session with more of an extended run to the upside throughout the day, then there's your runaway gap that you would not expect to get filled for a while at least. All right, until we potentially retest that lows, but I would expect that we wouldn't retest those lows. At the worst, we'd retest the top of the gap, wherever we open up at. So I'm not saying that's going to happen tomorrow, and we could, because remember, we're expecting a big day to come out of nowhere here. I would actually prefer it to, to get that big, huge day, I would actually prefer us to gap down a little bit and then rally throughout the regular trading session with a big, strong range. But, you know, if we end up getting a runaway gap, then we'll take it, right? We'll know we'll get a decent run, you know, potentially up through these gaps and up through that volume gap there, and then eventually up to maybe this even 302 level, which by the time that happened, probably would be the high. As you can see, the high is going to eventually start working its way down to this point for about a week or so, and then after that, it's going to work its way down, down to this point, or this will be the high of the 4-week range. So we'll kind of keep our eyes. You can see it's going to start shrinking here as we start slowing down on the pace of pushing the lower band down. That's the other thing too that's so extreme is this Bollinger Bandwidth. And this bandwidth's not even done, but you can see just how extremely high that bandwidth is. To get up above these levels, we're at what, 40, where is it at today? So, and it's not, it's obviously the lower band's not rising yet. That's what's going to start shrinking the band. As the lower band starts rising or starts slowing down its descent. We're at 44.613. So 44.613. That's how high the Bollinger Bandwidth is now. So if I zoom out here and kind of go to some of these higher levels, that is as high as it got in 2009. So again, it doesn't necessarily mean that we're going to stop going down. It just means that selling pressure is abating. It's a really, really strong level for the Bollinger Bandwidth. Here's the other times in 2002 we never even got to these lows, and then to go back to all the way back, and we'll do SPX to kind of give you an idea there. Same thing. I got to draw that line on SPX. Now we're at 44.32. 44.32. If I were to let you see, so there's 2008. 2008 actually didn't get to this low point. There's 2002, never even got close. The line wasn't even on. There's 1987. So when we talk about how extreme we are now, just remember that 1987. Look how low below the lower band we got. I mean, we were down to about 30.37 below the lower band. I mean, we didn't get that low this go around. We got lower this go around some of these others. So this is a fast move, but not nearly as fast as that. I mean, that was a 20% down move in one day. So that's why your Bollinger Bandwidth expanded as strongly as it did there. You have to go back to 1940 to get a bandwidth as low as big as we did here. Obviously always to the downside on these, and you can see again how far down below the lower bandwidth we got. And then of course a couple of times in 1929, similar, we didn't drop very far there. And then this was to the upside. We had such a big rally off of that low point. We had the Bollinger Bandwidth we pushed up. So it kind of gives you an idea again of just how significant we are. There's only very few periods of time in history that the bandwidth is strong, and the bandwidth's not done. Again, we're falling. The upper band's falling, but the lower band's not rising yet. That's what's going to start to shrink the band, and we're not to that point. I also mentioned too, I think I've shown you this before, but it's continuing to make a run to lower levels. But here's today's trend quality indicator on SPX down to this -26, and again to kind of give you an idea of how strong that trend is, and again, this doesn't necessarily mean that we're going to bounce significantly to the upside, or we're going to V bottom to the upside. There's 2008. You notice we never got this low. We're at -20, 27 right now. 2008, we never got this low. We got down to minus like 13 or 14, and then you come over here to 1987. We got down to -20 on this trend quality indicator, and you can see in 1929 we got pretty close to -23. So we are pretty extreme here. What it means is we have relatively low margin of safety to the downside. It's going to be hard to maintain a long, strong trend when it's already so extreme in this direction. It just means that there's an opportunity here, in this case, even just to move up to the blue line, which will act as a resistance, as you can see here, when we initially touch it. And that's way up at 2,800 again. Similar levels that we've seen before on SPY for these bounce backs, where there's going to be some pretty significant resistance, and that's at the current pace. right? So again, we'll make a big chunk of that up in 1 or 2 days, but those 1 or 2 days are going to come out of nowhere. They're going to pop up. There's going to be big moves. The VIX is not as high as it was, but it's still pretty darn high. At 61 right now. You remember those other days that were the highest days ever for the S&P 500? We can only go back to 2008, but in this October 2008 period, the VIX was up in the 70s and the 60s. Okay. So we are there again, right? We're down from 80, but we're still at highs where we can get record moves on the S&P 500. Top 10 type moves. Again, those days that you don't want to miss out on, but will come out of nowhere, right? So it's not like we can try to time it and try to find it. But also keep in mind too that these divergences that have been setting up on the RSI and the CCI. They're the high point in between those to test is way up here at 3,100. I don't think we're going to get there anytime soon. I don't think we're going to get back above 60, which is what will change the trend. I don't think we're going to get back above positive 200 on the CCI, but to get a move up to 100, to get to move up towards 60 and peak, and kind of like this peaked on the downside here, and we bounced up off of that. That's when you'll see me get really bearish. Hit that 280 level, 2,800 on SPX. Hit the moving averages. Get the light green shading, the yellow line. Hit that blue line on the Ichimoku cloud. Then we'll have an opportunity to be bearish again, make some bearish trades and retest those lows. Because remember, the next move down to these lows won't be nearly as fast. And it only took a couple of weeks here. It'll probably take 2 or 3 or 4 times that long the next go around when we face down there, as we've seen in other times where we've retested lows after big, extreme, fast moves. All right, so for our trade idea of the day, I want to take a look at a stock that's been pretty. It's actually a trade that we've been in before. In this video, we traded it to the downside here. Not in this stock? It's actually on Microsoft. After this bounce up, we traded it to the downside, and it actually worked out really well for us. That long put vertical barely just closed at maximum gain. But you can see it's at a pretty important level here. In fact, and you got this overbought, oversold cluster. But if you look at the weekly chart, it's actually been such an outperformer that if you look at it on a weekly chart, it's just barely rolling over, right? You just barely got dark pink shading and red line. We could be bearish here for a while on Microsoft. To kind of give you an idea where we're at on the 50 and 200 day moving averages here. We don't even have the death cross yet. As we're rolling, as we've broken below the 200 now and have stayed below the 200. And then you look at like the Bollinger Band width, and you say, okay, well, where are we at here? Well, we're right at the 1 year point of control. There's not very many stocks that we're at the 1 year point of control. You can see if we break down, there's the next ledge at 106-ish for the 5 year point of control. And to kind of give you an idea too on the Ichimoku cloud, obviously we're below the 1 year cloud, but on the 5 year, we're just barely hitting it. And when you break through that, as we've seen with the S&P 500, when you break through that long-term cloud, things can get really bearish there. And so you can see it over here, it got really bearish there before we rallied back up once you broke the cloud. So Microsoft has the potential of getting pretty bearish here, while kind of catching down to everything else. It hasn't fallen as much. It's been an outperformer, but if it catches down to where everything else is, then there's an opportunity to take advantage of that. And the nice thing is, in our class portfolios, we have so much. We've been adding some positive deltas trades here in recent market outlook videos and in our class, and we have quite a bit of positive deltas in a really directional trade that we have. We have an opportunity to be bearish here. If we bounce, we're great because we got plenty of positive deltas in our class portfolio. If we don't bounce, then we fall more, then this can continue to act like a really good hedge, like the last put vertical did that we traded on Microsoft that just barely ended here in March expiration. So let's take a look at the trade that we want to do. So let's come here to Microsoft and pull it up here. And you can see we'll go out to April expiration. and we'll just come down to, let's see, we'll sell this 115 delta, and you can see by April expiration, if I go back to the 1-year chart, and here, let's just do the Bollinger Bands again here, sorry. Oh, yeah, here, and let's go back to the Bollinger Bands on Microsoft for the 1-year chart. So you can see 115 is right within 1 standard deviation to the downside. Remember, if we break through this on the 5-year chart, there's not very much support here. It's a really easy opportunity to fall down. But you can see, if I were to sell that 115 and buy the 120, my price, depending upon where I get filled in at, my price is relatively cheap. I can get in at a pretty decent price and keep my risk really good. This is what we were looking at earlier. It was actually at 99 cents when we traded it during the Market Outlook Live video. We were going to risk a full position size because, again, we got plenty of positive deltas if we go. And we got that really strong resistance above us right now, right? That really strong resistance level, that point of control in the 1-year chart. And if we go down, then we can make a really good return, a really good hedge for that. So we can keep our loss really small. If we go up and lots of resistance, so it's not going to go up really sharply unless the broad market does. And if the broad market does, we have plenty of positive deltas that will way more than offset the loss in this. But if we go down, then we got a really good hedge. And like I said, if you don't have that, a lot of positive deltas, and this is kind of another bearish delta. Most of you have positive deltas, especially in your long-term portfolios. You're like heavily positive delta. So if you don't have a lot in your active trading and you want to be more aggressive to the downside, then you probably want to position size smaller because this is a pretty directional speculative trade. So you want to probably cut that position, and what a normal position size, cut it at least in half. So that way, if it does bounce up off this support, then you have a very small risk for the reward you're trying to get. All right, well, that wraps us up for today. Again, if you've heard from me now I want to hear from you. Use that link right there popping out in the top right corner of your screen. Let's go to our community and let's keep talking about this. Open up any questions or any comments you have that you want to keep this conversation going. You can reply to anybody else's comments and comments and questions too. And let's keep this discussion on our market outlook and what's going on the markets here. Again, the big beneficiary, especially in times like this, is the community, and being able to talk about things with other people and talk through things to get their perspective. And that's why it's one of our big 3 pillars at Market Scholars is community. So make sure you go there. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the video. And join our Market Outlook Facebook group we've created, as well as our website, as I showed you earlier today. Thanks again for watching, everybody. Have a great rest of your Monday evening, and we'll see you all tomorrow.